Thanks a lot, Anuj, for the introduction and setting the context. Hello, everyone, and welcome to this interesting panel discussion on building trust for tomorrow. So, trust is a simple yet heavily loaded word, and it's a very, very important ingredient for any relationship, whether it's a personal relationship or a commercial relationship. So, today, with this highly experienced panel, I want to spend the next 35 minutes discussing about this trust relationship between a borrower and a lender. We have been talking about this issue of underpenetration of credit, and in fact, the previous speaker, Ram Gopal from Perfios, talked about it in great detail, how the credit has increased to the underserved market over the last 4 5 years. There have been issues on availability of data, transparency, sanctity of data. So there is a high requirement that we possibly get into using more secondary tools, more secondary data which is available in the market to assess these smaller companies, MSMEs, etc., so that lenders can develop that trust and start lending to that. So that is the context, and I have a highly experienced panel along with me to speak on this topic. So Meghna, let me start with you. And you have been running Crediwatch and doing a lot of work on this credit SaaS and how to use alternate data to better develop a credit understanding on a particular exposure. So would you like to share with us, like, what are the new tools, what are the new set of data that you are looking at?
Sure. So thanks for the context, Shubham. Increasingly, if we look at the evolution in the financial services landscape of the last few years, and also the impact of the different regulatory and policy measures that the government has taken in terms of digitization and digitalization, a lot of streams of alternative data has become available because of the increased efforts towards digitalization from the government and also from the private sector and from the businesses themselves. So if you look at it traditionally, when we're looking at the concept of credit assessment or the concept of credit rating, we would mainly focus on financial information, right? But when we're looking at the context of credit assessment today, when we're looking at a larger, market in terms of not just, large businesses, but, different kinds of small businesses of all shapes and sizes that have become a very important opportunity in terms of, being able to get access to credit, creating a $28 billion industry in India today from the fintech perspective. Because we look at the fact that there's so much different kinds of data available, which means you can paint a very different story, which could be more positive from the perspective of pricing risk for a lender, right? So that's kind of what we've seen, and these kind of data streams could be, it could be data from GST because now it's mandatory to file GST online, data from bank statements and account aggregators, and especially companies like Perfios, who in the previous session have done a lot of work in terms of being able to help digitize this particular area, because 80% of the country today has a bank account. And other forms of data, for example, one is the intention of a business to pay, and the ability, right? So if your behavior from different sources, whether it's if there are a lot of cases against you, or are you filing your forms on time, are you compliant? So all of these different kinds of data sets that are increasingly becoming available helps us to understand borrowers better, especially smaller borrowers who may not have robust financial statements, but they may be having fantastic business in terms of the kind of actions you get from the GST data or from any of the transactional data in the flow of their business. So that's kind of what we've seen as a trend.
Great. Meghna, and you brought out very important points about how the digitalization has improved the availability of data like GST filing, PF, etc., etc. So Aniket, availability of data is one thing, but again, the sanctity of data and accuracy, because someone is believing that data to take a lending decision. So what are your thoughts on that how can one really validate the data what is getting? And another part of this question is that whether we have enough data sets now to get to some reasonable analytics on that.
Hi, Shubham, thanks. I think a very, very, very valid question, very important one as well, because I was just hearing to the previous speaker, and what I could make of it is that everybody understands that there's already a lot of data in the market.
Right.
There's maybe you can call it a data overload. Be it alternative data or traditional data sets, right? But what is going to be more important is how we can make that data consumable and how we can build make it more decision grade, right? So that's exactly where the accuracy part comes in. And I think where we may go ahead and complement the government of India in taking initiatives to digitize data, but the data is available in different forms and shape. It's unstructured. Extraction is a challenge, and homogenization is also a challenge. So a lot of effort needs to go in homogenization of data, uh, making sure that it becomes consumable as well as analytics ready. Uh, just to share a few examples on that, just for the benefit of the audience. You have an individual person's name, but you do not have a PAN number attached to it on a data source. So again, data abundance is there, but how can you really use that data? The names of the entities that are mentioned on multiple alternate data sets, those names may have some sort of discrepancies. There could be some differences. So how do you automate that? Without that, analysis of any sort of data would be incomplete and inaccurate. And there has to be a lot of effort that needs to go in terms of homogenizing this data and making sure that it becomes more consistent.
So just to extend that point, Aniket, how are you seeing the acceptance of this data within the lenders system? Like, are they becoming more acceptable and amenable to use this data?
So I think again, data is very accepted because most of this comes from trusted websites of either the regulators or the government, right? Social media has its own pain point and has its own upside as well. So it comes in, people understand that, but the acceptance is there. I think what is not appreciated and accepted today, and where I think companies such as Corpository, Crediwatch, everybody is trying to make a dent in that space, is how do we make patterns more acceptable? How when we read patterns across alternate data, can those patterns really indicate something meaningful? And can they give us an early warning, or can they give us some sort of an edge in terms of predictability? So I think that's where the entire industry is still struggling to accept it as is, and everybody has their thoughts. People are still understanding how exactly to use that.
Okay. So you mentioned about early warning, and so early warning is not only useful for like new to credit, but definitely for a lot of traditional businesses, houses, and all. And Ravi and Venkat, I remember maybe coming out with a regulation, possibly I think 2.5 years back, where rating agencies are supposed to monitor the early warning signals on a very, very regular basis. In fact, on a real-time basis. So if you can throw some light that how you have incorporated technology, Ravi, to basically get this real-time monitoring of the early warning signals so that no one misses the bus, and the responsibility towards investors and lenders is fully mitigated.
Yeah, thanks, Shubham. It is indeed true that regulator, SEBI came out with certain guidelines for credit rating agencies sometime in 2017 or so. They expect rating agencies to monitor companies on a regular basis, and what they call as material event. If there are certain defined events like quarterly results, or if there is let's say major M&A development, or if there is let's say lockout in a particular production unit which impacts production, and so on and so forth. There are certain defined material events which we are supposed to monitor and go to the rating committee for review. In addition to that, we also realize that it's not important. It's important to look at other than financial statements, only then we'll be able to monitor the credits closely and do justice to the investors and lenders. So in that regard, we have been investing quite a lot, also training our manpower, the credit analysts on various aspects of market surveillance system. So we are also been subscribing to some of the third-party vendors database. We get signals like deposit of provident funds in EPFO, GST payments, and let's say any reference to NCLT for insolvency related proceedings, litigations related stuff, or income tax rate, and so on and so forth. So analysts are really up to speed these days, and every day they get a mail from the vendor if there is any major negative development about a particular credit in their surveillance list. Which is really helping us to monitor, especially in small and medium scale category. disclosures are pretty good when it comes to large corporates, but when it comes to mid-level and small corporates, since most of them are unlisted, these additional indicators have really been helpful for us to take a rating call. Depending only on them to provide information would mean that we could be very late in taking rating action. By looking at these additional indicators, we believe we have been able to our rating process and overall analytical rigor has improved the way I see it.
Sure. So Venkat, like what Ravi has said, it seems that these new fintech tools has come in very handy and actually proven as a boon. Otherwise, a lot of manual bandwidth would have got occupied in this, like monitoring on a manual basis, you're doing through Google alerts, etc. So how would you rate this, and possibly at India Ratings, if you can tell us how you are going about this process?
Thanks, Shubham. In fact, Ravi did explain. It is, in fact, there are a lot of simulation tools available. I mean, one, just to give a background, when a credit rating agency gets into assessment, and one thing that it is very careful about is the default. I mean, the payment default that happens. That's the background. So, especially on the debt instrument. So, it's just simulation. When we do it, for example, we do it like a base case and stress it to the maximum extent, and we have market data available on the SaaS providers, so we get multiple access. I mean, otherwise, just manually, just to Google it and, finding it is so difficult. So the technology tools and the SaaS providers, we really depend on them to get the data. And with that data, the simulation, when does it breach a particular deadline? We always have something like a basic ratio, the breach. We always set a breach limit. So when the breach limit, for example, I mean, the tools have completely improved. I mean, 10 years ago, default recognition and default, how you calculate a default, when will it occur? The occurrence of a default is very, very difficult to find. So today, you have systems in place where you can actually say that if this is what the revenue is and this is what the expense is based on the projections and based on the past historical financials, you can actually say that, in the next month or next to next month, this is going to go to a level where the liquidity is going to be quite critical. So a lot of mass data. The one disadvantage though is, you have so much of data available in the market, so which data to pick up. Especially when you make projections. Rating agencies always end up in projecting rather than looking at the past. That's a basic difference between auditors and rating agencies. So, you have to actually marry the past with the future, and then with that kind of a data getting into it. So, apart from, what we are doing is, apart from the systems and the data that is available, we also do simulation case. Now we have actually introduced something called as, a rating case and base case, and so many stresses in the criteria, so that, we arrive at the right judgment, because default is a very, very sensitive matter especially when we go and predict a default. Of course, there's no problem about very highly rated agencies. I'm actually talking about some, very, very weak credit that is going to default now. So that's how we do it, Shubham.
Sure. And Venkat, again, what you were saying actually has rung a bell in my ears. Like, you are hinting towards usage of AI and ML and by rating agencies also, I think. And I think that's the way it should be. And that's where we should move forward. So would you like to spend a couple of minutes on and you have been a stalwart in project finance credit assessment. So would you like to speak about that, how credit for project finance can be enhanced using AI and ML?
Certainly. Thanks, Shubham. It's a very interesting subject, Shubham. One thing that is very difficult, especially you are in that field, is the linking the AI ML to infrastructure financing. More or less, because our banking system and the NBFCs today, if you look at the average exposure, I mean, the average tenor of banks is about 4 to 5 years, and the NBFCs is about 2.5 to 3 years. But the need for infrastructure, when you actually go into infrastructure, because of long gestation and long life cycle, at least you need an average tenor of about 10 to 12 year minimum, at the minimum, once the project starts kicking in. I mean, especially. So, all the data today available, from the banks or NBFC perspective is too short term, and it's very difficult to actually, kind of project it for the long term, especially for infrastructure project. That is going to be that is definitely a challenge. I don't find any great immediate solution to that, but definitely the data really helps. Especially banks or the sole lending agencies. So I would like to call this, say for example, a batter is ready but a stove is not, because first of all we need, apart from AI and ML, we need a long term sourcing institution to actually basically fund these needs. Otherwise, what happens is the risk keeps moving up. Apart from the infrastructure life cycle risks, you also have interest rate risks on the liability side, and that comes up. Of course, AI and ML really, visions to reduce those kind of risks. Especially, they have actually acted mitigants. You yourself have actually done a deal, for infrastructure financing recently. So it has been quite a challenge, unlike the corporation. Now, actually, corporate is more or less, aligned to that. I mean, at least there is a concept called AI and ML in this, and, a lot of data pickup, etc. So the biggest challenge is how you link the liability, the risks, and the asset profile to that. That is being taken care of. And now, more and more specific infrastructure based AI and ML are coming up. Recently US did a mini bond kind of a deal, not just here, but even in the US. It has been a challenge where actually long-term markets, where long-term liabilities exist, long-term financial institutions exist. Today, we have very little data on these type of instruments. And India houses the largest number of SPVs and PPPs. So we need that kind of a data. From the asset side, I think most data is ready. And now we have experience about when this how these projects will perform. Now India, as I said, India houses largest number of SPPs and PP, on a PPP mode, etc. From a liability side, just from when the sourcing side, I mean, when we actually try to expand it, and if we have like with AI and ML, if we can have that kind of a syndicated deal through the platforms that exist, we'll have more data, and that will also help this project financing thing. I'm very positive about it, Shubham.
Great. Meghna, coming to you, and again, we were discussing that day, like income, I think all the rating agency combined rate around maybe 50,000 odd entities, and we have almost 60 million businesses running in the country. So from that credit assessment point of view, or to make those entities which are not rated or covered by the rating agencies, to cover them, to provide that comfort to the lender about their credit. So we need some kind of credit score, which is unbiased, acceptable to the lender. I know that you and Aniket, you have been working on such credit scoring models. If you can start, Meghna, and then I go to Aniket for his view.
So, Crediwatch has always been in the business of using AI and ML to help, power insights and effective decision making with the best lenders in the country. So we've had the unique opportunity to be able to access different kinds of private, proprietary, and public data, from multiple sources, and create unique models and have them deployed at regulated entities like banks. In fact, the Crediwatch scores, I think, are the first AI ML based scores that a lender is using today live in India, and probably one of the few in the world, where it's actually being used for making such a decision as part of the credit assessment memo in a bank today. So the reason why, this is extremely important in terms of a milestone is, like you rightly pointed out, we have 50,000 ratings, right? And we have 60 million businesses. So to service debt for 99% of the rest of the SMBs in India, you actually need an alternative to rating, right? Which would help, price risk. And because ratings are expensive, because they're a very complicated endeavor, it's important that the lender himself may be able to take the cost of that soft alternative rating, and it should be viable in terms of issuing the credit, right? So that's the direction in which companies like us are working. We work, of course, closely with rating agencies themselves and supporting them to be able to expand the universe of ratings that they're doing, because they're extremely critical for our lending environment and ecosystem. And at the same time, we're trying to work to fill the gap where they're not able to come in by helping lenders, even take on the cost of pricing the rating rather than putting it on the borrower themselves, which is what has traditionally happened. And also use AI/ML to create these sort of scores that gives lenders the confidence to price the risk and offer, loans to customers who are essentially thin file borrowers. So the Crediwatch Trust Score and the Crediwatch EWS Score, where we have kind of given analytics over $24 billion worth of loan portfolio till today, and are live as a model in many of our customers, is one such example.
That's great. Aniket, your views?
Yeah, I think how we see this space is that credit scores that come out from an ML based model from a company such as ours could be something that could be used side by side with a rating. The reason is that multiple times what we have seen is that the rating agencies are ahead of the curve, but the rating agencies have regulations to follow. Right. And that is where, because an entity may have a very strong parent, an entity can have or would have gotten liquidity by selling some assets, just based on liquidity positions. And because they have an actual impact on the finance cost, there is a lot of times the rating agencies are ahead of the curve. And yet it seems that the rating while going down in terms of a downgrade, someone acted late. But that's not the case. So that's where we feel that fintech companies such as ours could be a very good tool, which can be used side by side. Can also be used as one of the alternate data sets for rating agencies themselves. Secondly, what I feel is where we fill the gap is that again, because rating is a costly exercise, as Meghna put it correctly, this happens once or twice a year.
Yeah.
Right. Whereas a lot of alternate data set variables change very frequently. So, for example, as a part of our modeling exercise, the heart of the model is to keep it extremely sensitive to the daily changes, right? And then sort of figure out a way or figure out a particular area where if a particular score or if a particular grade remains there for a particular period of time, then you sort of benchmark it with defaulting companies. But this changes on a day-to-day basis, right? Yeah. So it needs to be more flexible. So I think these are the two main areas. Third, which I think that someone again, such a company such as ours would be able to add to the domain is where we could help borrowers. Currently, ratings is more for the lenders. Other than the rating rationale that gets published in the market, it's more for the lenders to evaluate. But how do we help the borrowers to make them strengthen? Because that's actually one of the things which will help us deepen debt market. So I think the model can be reverse engineered and can be something that can help the borrowers to improve their books. So that's how that's how we see the industry.
No, great. Just one point I want to ask both of you, like how involved are the lenders in this process and methodology of framing these credit scores? Because at the end, they are the users. So are they active contributors? Aniket?
Yeah, they are. Oh, yeah, go ahead, Aniket.
Please start.
Yeah.
Okay, I'll take that. I think I agree to what Meghna says. They are extremely involved. And as I told, just reconnecting to the first point that I made, the industry is evolving. So the lenders want to try out a lot of things on their own. There's a lot of internal data that they have, right, which otherwise we do not have as external databases. So with the help of those internal databases, there could be a lot of benefits that can come. There is a lot of sharpness that can be added to the model. So they are extremely involved in this process.
Meghna, anything from your side on this?
Yeah, so of course, the lenders are very involved because we do rigorous testing of our models. In fact, for 4 to 5 months, sometimes when we're releasing a new model, side by side with the lenders. And the way we kind of prove a hypothesis is by challenging an existing model that the lender has already deployed and look at what kind of lift we get by using a Crediwatch model. And from that perspective, it's pretty important to get feedback from our customers. And we do have a feedback mechanism that helps us continuously improve our models because we are kind of plugged into the ecosystem of the lenders. And that kind of feedback really helps us improve it. And these kind of models then become useful for the entire industry.
Sure. Ravi, you have a lot of financial service companies in your portfolio, large companies, new age companies, who have become very active in co-lending or lending to these SMEs, MSMEs. So what is your view? Because possibly we are yet to see a cycle, right? Because this entire thrust on lending to SMEs, MSMEs have started over the last 4-5 years. And we have really not gone through a cycle because though COVID was a black swan event, but there was a lot of support from the government and regulator, which cushioned defaults. So what is your view? How do you see the market over the next 2-3 years?
Yeah, co-lending, while as a concept has been there for almost a decade, for various reasons it didn't take off. Only in the recent past, with the clarifications from RBI on how the partnership should be between NBFC and the banks and so on and so forth. There has been some pickup on this trend over the last 2 years or so. Of late, we are seeing a lot of traction, wherein we are seeing that public sector banks, they're getting into MOUs or agreements with the new generation NBFCs on this particular aspect, wherein initially the screening is done by the new generation NBFCs because they have the wherewithal, they have the first of all reach, they have branches in several smaller areas, and they are invested in credit assessment of these kind of companies, various schools. So they are in a position to pick the right credit and do a lot of due diligence. So because of this, they've been able to keep the asset quality under control till now. And on the other hand, there is also a worrying sign. Some of these NBFCs have been giving, what is called FLDG, first class default guarantee. Sometimes can be 10%, 20%, 30% extra, depending on the relative bargaining position between the other partner, banking partner, and the NBFC. So long as the going is good, both the partners will thrive. But if, let's say, in a really weak credit environment, the defaults will have to pick up, then those NBFCs which are originating the credit and giving this FLDG could be under severe stress. So that is one thing we are concerned about. But as a concept, it is really taking off very well, and I believe quite a lot can be achieved in terms of AUM growth, in this space. So wherein we believe that both the parties are doing well in terms of an ROA basis. If you analyze the this particular model, it's going to be very well for both the partners. Just that we need to be clear on their aspiration. As part of their aspiration, they shouldn't be taking too much of this and FLDG kind of commitments that can be a spoiler in the market for the medium to long term.
So okay, let me ask you this question in different words. So some of the NBFCs have grown very rapidly over the last maybe 2-3 years. So do you think that the learnings from the past have been incorporated fully and which has led to improvement in underwriting skills, etc., and we may not face what we have faced in the past?
Certainly. In fact, that is one good thing which has really happened. They have invested quite a lot, in improving the underwriting practices. So the very fact that some of the NBFCs are looking at some 100 different kind of metrics to analyze a company and decide whether to lend to this entity or not. That itself is a quantum leap in the way we look at any credit. So indeed it is there. Just that some of them have aggressive targets. Most of these NBFCs are funded by private equity and so on and so forth. They would have very steep targets, 20%, 30% every year. Some companies are growing by even 100%, doubling every year. So in the quest for growth, this will end up compromising on those principles. So operational control is very, very important. Frauds and those kind of risk will be contained. In addition to controlling greed is also very important. That's the key thing. Otherwise, I believe that all the companies realize that it's very important for them to control asset quality. Only then they will be able to sustain in this business for a longer period. It's just that some companies are taking the extra risk, which could hit them over the medium to long term. So long as the credit cycle is benign, everybody will make money. Only when the tide turns, then we will realize who took the aggressive bets, and they could repent at a later point.
Thanks, Ravi. Venkat, again, you have been in this debt market from a long time, and in fact, personally, I have attended a lot of conferences, seminars where the topic always had been deepening of bond markets. So that's the theme which is going on from possibly 2 decades at least, since the time I am in my career. So how do we build that trust of money market investors? What is lacking? Why still they are more comfortable with AAA and AA names? So is this the transparency which is an issue? Is it the governance which is an issue? Would love to hear from you.
Sure. Thanks, Shubham. Good. It's actually a very good question, and it has been in literature for quite some time. If you look at the RBI speeches, they have very interesting speeches. And we have been thinking about this right from 90s. It has various aspects. One is when we call about deepening the debt market, it is not just one thing or interest rate. Number one is from a pricing perspective, right risk, right reward, right arbitrage, that kind of a thing. Second thing is from a risk reward thing, you should be able, the borrower should be able to get the his needs, at the pricing that he wants. For example, various risk buckets like AAA, AA, etc. And there should be lender to actually do that. It's very interesting to see, for example, when ICICI started, or when IDBI started, when IFCI started, those actually were providing, they wanted to start like a long-term financial institution. You may remember that quite well. And latest is IDFC. All those institutions actually wrapped up, and now they are very successful in a commercial bank form. So are we saying, I don't know whether, are we concluding that India doesn't need a long-term market? For example, all the long-term funding markets or institutions wrap themselves up into working capital banks, be it ICICI, IDBI, or whatever. And latest is IDFC, which is now IDFC Bank. So, is it just because there is no, appetite for those kind of borrowing? Which I presume it is not. As in the previous session, I was just mentioning that India houses the largest number of SPVs, and today infrastructure developer feels that they need, they feel that they need long-term money, 10-year, 12-year money, or even 25-year money. When concessions are to 20 years and 25-year concessions, basically the average tenure of about 4 or 5 years is actually funding them, and that probably is also one of the reasons why default is actually happening. So, which means that our debt market is certainly not suited. Of course, the corporate debt market now, now that the capital, the capacity utilization has been good, and no, capital spend is now, just the cycle is up now. Again, so until then, even those capital cycles for corporate is very easy to be filled up with 4 or 5 year loan, because those are private sector, etc. But definitely not with government type of infrastructure assets like roads and power, etc., which needs about 3 to 5 year of construction period, etc. So the thing is, we definitely need more depth. But our banks are now used to infrastructure lending. Only thing is, the sourcing, etc. So we need more kind, when we want that the deepening to happen, we need to. I'm sure that the AI and ML platform would help. The right need and the right liability and the right asset, and especially as far as tenor is concerned, the pricing is concerned, the risk is concerned, etc. So we expect that that's going to take some time, but it will definitely develop. Now, the regulators have come out with new instruments called IDFs. Those are actually bridges, very good bridges. IDF is a very good bridge, which can fund, those long-term requirements. So as long as at the right, for example, take in Australia, even 75-year concession and 50-year concessions, those are actually being funded by bank loans, right? So, the banks are able to, demonstrate that kind of lending. Today, the construction risk has always been, funded by banks today, which is very good. But we need more and more avenues to take operations risk and release the money for banks to do more and more construction, etc. That's what I at least mean by deepening of debt market. I'm sure that will happen, whether it is bond or bank, etc. Banks are very more experienced now in infrastructure finance lending, different lending. For FMCGs, for cement, for textiles, for roads, etc., etc. I hope that answers the question. Sure.
Ravi, any quick thoughts on this? That other than governance, transparency, any other factor you attribute to this issue?
Yeah. So without repeating the issues raised by Venkat, I would think two more important things which have to be addressed. Number one, liquidity in the secondary market for these bonds. And number two, the bankruptcy regime, in the country. With regard to the liquidity, given the outstanding bonds in terms of value, actual amount traded is in low single digit. So liquidity has always been a problem for the Indian market, and so that mutual funds are really struggling, to make dent in the corporate debt space. While they have mostly open debt schemes, when it comes to selling the papers, they are not able to sell the way they would have liked. So that's a fundamental issue. While SEBI has been trying to come out with market making mechanism, we need to have serious attention in this space, and we need to incentivize these market makers. Only then, we can have good liquidity. Just like the way we have a, very good equity market, even better than some of the developed economies. We require similar kind of liquidity when it comes to the bond market. That is one thing we are doing, but still a lot more needs to be done to incentivize the market makers. Number two, on this bankruptcy regime, today, despite all the efforts, it's almost 5 years since this new insolvency regime came into the picture. Even though it takes anywhere from 2 to 3 years to recover, to resolve high-profile insolvency cases, that can put up any serious, bond investor, whether domestic investor or foreign portfolio investor. So we need to, reduce this time to less than 6 months. Only then confidence of the, the bond market participants will enhance. Otherwise, they will stay put with only AAA and AA papers, where the probability of default is very low. So recovery aspects is very important. So we have to do further introspection and further amendments in the insolvency regime, to send really right signals to the global and Indian investors.
Thanks. Aniket, a while back, you raised a very important and interesting point that like the credit scoring models currently are focused possibly on lenders, but it can also be focused on borrowers to make them lendable and credit ready, right? So yesterday, in fact, I was having a chat with some of my colleagues, and we were discussing that how can we create that awareness that, okay, you start having transparency in your books, you do right reporting, right compliance, etc., etc. But my personal experience has been generally companies and promoters and proprietors, there is a bit of resistance in sharing data. They don't want to really share their data with you because of various reasons, etc. So how do we develop that trust where like companies like yours, Meghna's, can come and really convince them, okay, you start sharing data and this will only going to help you?
I think one thing could be where we have to develop the trust for the borrower. If that is the question, then one thing is that most of the time the data sharing is a problem because of its privacy.
Yeah.
People and these is not just a PAN or a phone number that we are talking about, but these are actual financial records, GST statements, and all of this data is extremely rich in terms of in terms of its information and intelligence, and it's obvious why people do not want to share it. I think one thing will be about educating them how this data is going to be very private, how data security is taken extremely seriously. For any company which is taking this data, they should be, I think, first of all, they should have that confidence over there. We should give that. And I think secondly, even after doing all this, the motivation will come from, can this data really help them to drive down their finance cost? So that's where the entire ecosystem's role will come into play. So so today, for example, rating agents, they do not have problems in giving this data to rating agencies because they know that if rating agency gives them a AAA, then the finance cost is less. Whereas if Corpository provides a score, it may or may not have an impact on their finance cost, right? So how the entire ecosystem is going to adopt scores as well as patterns and ML-driven models, and how that is going to have an impact on finance cost, I think that education should flow down to the borrowers. And then this entire reverse engineering that I was talking,
sure.
That will have a massive impact on them, because then they would be ready to share data. Then they would be wanting to see what is the quantified interest cost that they are saving, and things around that.
Sure. Meghna, anything else other than data security and privacy? You think any other constraint that one may be facing in sourcing data?
I mean, I agree with everything that Aniket. Hi, can you hear me?
Yeah, Meghna, it's slightly broken. Yes.
Okay, yeah. Yeah, great. That Aniket just said, especially on information security and privacy. There's a lot that kind of needs to be done in educating SMEs to be able to share data so that, they can analyze it for effective decision making so that they can optimize their own working capital cycles. So in fact, in the past 12 to 16 months, that's been one of the products that Crediwatch has out in the market, where we're working with over 6,000 small businesses and helping them make decisions about their own, customers and vendors, especially in terms of the days of invoice credit that they need to extend to their own customers. And I feel like, if you actually get to scale this and more players work on this problem, we lose about $100 billion a year in India because of delayed invoices that SMEs have to face the flag and bear the interest cost. So that will kind of really help lenders also reduce rates because it streamlines a lot of efficiency in the working capital cycle. So from that perspective, it's a two-sided problem. One is to kind of be able to price the risk, help scale that, and the second is to make SMBs more efficient in managing capital so that then they could get a better price in terms of a financial product. And that's what companies like us are aspiring to do.
Sure. Great. I really enjoyed this discussion. A lot of points in my head still to discuss with you, but again, time is a constraint. But I'm sure the audience must have benefited from the various trust building initiatives that we have discussed, rating agencies and fintech SaaS companies are taking to build that kind of trust between the lender and the borrower. And it will help definitely in penetrating the debt market. Just want to end with one by quoting a number. I was reading Deloitte's meta study, where they quoted that with every increase by 10 percentage point in the trust between people, the GDP growth gets a bump up by 0.5 percentage points, which is very significant considering the overall global GDP growth of 2.5%. So I hope that we will be able to really deliver on these trust building initiatives through all the hard work efforts being put by all of you. Have a great day. Thanks a lot for joining us.
Thank you.
Thank you.